Welcome back. It's nice to see you. I hope you're well.
I am, and by the way, you're doing a great service. Your show has really become enormously popular for a reason, because you're giving out some good information, and I appreciate it as a viewer.
Grateful for you to say that. Thank you. So let's take the jobs report and look at it in the. Can you hear me? You know what? We'll try. Richard, can you hear me?
I think we're back on.
Okay. First and foremost, I said I'm grateful for those words that you said. Thank you for that. Secondly, let's take the jobs report in the bigger picture. And how deep and how long do you think this lasts in your mind?
It's hard to quantify specifically, but my guess is we're in for a U-shaped experience here. The question is how prolonged that U is. Setting aside economic projections, you have to put yourself in the role of a worker that's been laid off or as an employer who has laid off workers. And let's remember, the people that create jobs in this country are not listed in the S&P. They are the small and medium-sized businesses that are covered by surveys like the NFIB, National Federation of Independent Business. These guys are severely strained right now. There is an effort to get money out to them. The Main Street Lending Program, by the way, is it's not clear exactly how that's going to work, how much access people have, even though B of A and others have put up their lines. And you're going to be a little bit wary, if you're a worker, of going back into a high-density workforce in particular. That means bars, restaurants, transportation, sporting events, all those kind of things. That adds to 20% of our economy. That's a fifth of our output is in those spheres. And you're going to want protection. And if you're an employer, you're going to want to be able to construct yourself, reconfigure yourself to space things out. So I'm not of the school that we're going to have a V-shaped recovery. I believe it's going to be a prolonged U, and it's going to take time to work our way out of this situation.
And what policymakers have done to this point and what they can still do.
Right.
Have they done a good job in your mind? They've certainly done a lot. And what more can they pull out of the toolbox if necessary?
Well, first of all, the nice thing is we had the playbook at the Fed that when I was there, developed by Ben Bernanke and our team, we could pull that out pretty quickly. So they were able to do it off schedule, as you saw. And these are the kind of backstop programs we did in 2008, 2009 for a different reason, the collapse in counterparty trust. So money market funds, commercial paper, bonds, et cetera. We made every one of those markets. We retired those programs when they were done. It took us longer to undo the trust for AIG, but we brought them to a halt after they had done their magic. That is separate from expanding the balance sheet and the rate cuts or taking rates to zero. I think it's important to bear that in mind. Now, additional tools have been added here. The Congress has provided some fiscal backstop, particularly for the lending programs to business. The numbers are huge. If you net out the so-called strategic industries like Boeing and so on, there's about $4.5 trillion that the Fed could leverage from the $450 billion provided by Congress. That's a pretty big number. But at the same time, when you take all the bond issuance that took place in 2019, amongst those that go to the bond markets, and all the C&I lending on the books of banks at the end of last year, that number gets swamped. It's about equal. And it's a question, again, of how long this goes on. And already you saw Nancy Pelosi this morning on CNBC saying she wanted to do more. And we're just going to have to see whether or not this does the trick. It depends on how quickly you think things are going to recover. And I'm rather pessimistic that it can be a quick recovery.
So I'm just wondering if you can put us in the room and what you think Mr. Powell is thinking today, knowing that he may very well be faced with what the investor is faced with in what may be his new normal of no clarity on virus and no clarity on other side. So how do they think about what the future is going to look like from an economic standpoint if they're looking through a glass of milk on both fronts?
Good question. The Fed is a deliberate institution. Again, we had a toolkit. They had a toolkit they could draw on because we developed it the last time, and they threw it out there very quickly. Right now, I'm sure they're just, it's a natural Fed tendency to see if something's going to work. I'm going to say something I've said before to you and other folks on this network. I'm grateful that Powell is there. He has a credit market background. He understands the Treasury, having been Assistant Secretary, Undersecretary under George H.W. Bush. He knows how to work the Hill. These are talents that are coming to bear here that his predecessors, frankly, great guys, Ben Bernanke, great woman, Janet Yellen, did not have. But you always want to be cautious when you're at the Fed and you want to see how things are working. For example, the Main Street lending program is going to be pushed out and overseen by the regional banks, like the Dallas Fed, all the other 11 Federal Reserve banks in addition to that one, so the 12 banks. I think they're still trying to figure out how the heck they're going to do this. And what do they do in terms of forbearance or supervision, regulation? This is still being worked on. And until you have a sense that you can administer this correctly, you're going to take your time. Obviously, they can't cut rates further. Negative interest rates are out of the question. They've made that clear. You can expand the balance sheet. If you look at the balance sheet yesterday, it's pushing up towards $6 trillion. We're likely to see it go, as I've said before on this network, beyond 7, even before this crisis. So the urgent programs to backstop lending and to support employment that are going to be administered through the Fed, they're going to make sure that they actually can deliver and make those things work. And it's not clear right now whether or not that's been done.
Well, let me ask you this. You just used the words out of the question. You anticipated my next question, by the way. And you said negative rates are out of the question. Now, right. I know that the Fed chair probably doesn't want to go to negative rates. But what happens if rates get away from the Fed chair himself? I mean, rates are already moving lower. What if we just go down towards negative rates?
Well, we did see the 1 and 3 month trade negative for a brief period about a week ago, right? So I am of the school that believes the Federal Reserve has lost control of the yield curve. You can't say that the Fed pushed the 10-year down almost 2 weeks ago to below 30 basis points. I was in Australia at the time. I was meeting with the 2 big banks there and the large companies, the miners and Qantas CEO and others. They were hoarding dollars. They were doing everything they could to get into treasuries. And that, I think, is what a small microcosm in a very big market, but they're not insignificant, tells you that the market determines these rates. I believe the Fed has lost control of the yield curve. The only thing they have is the low fulcrum point, and the markets don't respect that as much as they used to. Mm-hmm. So the 2, the 5-year, the 10-year, these are determined, and the 7-year, these are determined by market forces. And they could indeed, since there is a enormous premium being placed on dollars right now, they could indeed push these yields much lower. The negative side of that is it sends a signal to a congressperson, I can spend still more, because the cost to carry is less.
Mm-hmm. Richard, we appreciate it as always. Thank you for being here.